We have used the term debt funds or bond funds or fixed income funds so often that we think we know how they work. But even seasoned investors can get tripped by the inner workings of these funds. In this series of videos, we'll try to understand how it all comes together. But first, what is debt? To put it very simply, debt is a loan. There is a borrower and there is a lender. The borrower borrows money by issuing securities, and the lender invests in these securities on certain conditions. It could be interest rate offered, time period of the loan, quality of the borrower's business, and so on. It must be noted, though, that unlike financial institutions, mutual funds are not in the business of lending. They are in the business of investing, and which is why the viability of this investment is of paramount importance. All this borrowing and lending takes place primarily in two buckets. The first is money market instruments, or those securities with a maturity, or to keep it simple, one can call it the life cycle, which is up to 365 days or 1 year. And the other is medium or long-term debt, which has a maturity or life cycle of more than 365 days or 1 year. You must have heard the terms treasury bills or T-bills in short, commercial papers or CPs, certificate of deposits or CDs. It all sounds very confusing, but it isn't. In reality, they are all securities with less than 365 days maturity. The difference being that T-bills or treasury bills are issued by the government, CPs or commercial papers are issued by corporates, and certificate of deposit or CDs are issued by banks. So essentially, they all serve the purpose of being money market instruments. They are given different names to distinguish them on the basis of who has issued them. Besides this, another popular avenue is TREPS, or tri-party repos. To explain TREPS, allow me to take a short detour. When a bank needs money, it can borrow from the Reserve Bank through a facility called the MSF, or the Marginal Standing Facility. As well, for routine daily funding requirements, they can access a platform called TREPS, where the underlying collateral are government securities or treasury bills. While MSF, or the Marginal Standing Facility, is limited to banks, TREPS market can also be accessed by corporates, including mutual funds. In fact, mutual funds are active participants here. They invest overnight money here and earn an interest on it. Next day, the cycle starts again. So these are some of the most common and widely used instruments for parking money with a life cycle or maturity of up to 365 days. The other avenue available is long-term instruments. These can be bonds, debentures, and pass-through certificates issued by governments, state governments, or corporates, in some cases even banks. Bonds are essentially fixed-rate securities issued by corporates or the government. It can be the central or state, municipalities, and they're often backed by a collateral or physical asset. Besides the plain and simple bonds, there are many varieties available. They may be inflation indexed or floating rate, convertible into shares at some time in the future, and so on. But they're all basically bonds, raising money for the borrower and paying out an interest in return. On maturity, they also pay back the principal amount, and in the event that there is a default or the borrower cannot repay, the lender can take control of the collateral to make good the loss. Debentures, on the other hand, may or may not have collateral, and which is why they likely offer a higher interest rate to compensate for the higher risk. Again, debentures can be of many kinds: redeemable, irredeemable, convertible. They may be based on percentage of collateral offered and so on. But again, they're all debentures. Due to the risk of not having any collateral, most lenders look to the creditworthiness, reputation, and history of debenture issuers before investing in their securities. And finally, PTCs, or pass-through certificates. Let me again take a short detour to explain. There is a lender A who has 100 loans which they have given out to individuals. Of these 100, let's assume that 50 are repaying their loan on time, 40 are delaying repayment by few days, and 10 have altogether stopped repaying the loan, or we can say those 10 have defaulted. Even though the large majority of individuals are repaying the loan on time, but as of now, they are clubbed together with those who are either delaying their repayment or not repaying at all. So, the lender A is having difficulty in raising money from the market at a competitive rate. So, let's assume that lender A had approached company XYZ to raise money, but this company XYZ says, they are worried that the 40 individuals, or at least most of them who are currently delaying the repayment of the loan, may also stop paying altogether in the future. So, as a measure of additional safety against this risk of default, they ask A to pay a higher rate of return if they want to raise money via a loan. Now, naturally, A doesn't want to pay a higher rate of return. So, what can they do? So, lender A creates an SPV, or special purpose vehicle, in which they house only the loans of those 50 people who are repaying on time, and therefore carry negligible risk, and therefore they can raise money through this SPV, which has only those 50 good loans. The interest paid by the original 50 will flow through to XYZ, or we can say it will pass through to XYZ. Therefore, the securities issued to them for investing in such kind of instruments are called pass-through certificates. Now the question arises, how can fund managers tell which security is good or which is risky? This is done by considering the credit rating of such instruments. If you have ever looked at a fund fact sheet, you must have seen AAA, AA, BBB written. As well, you might have seen A1+, A2 kind of ratings. But there's no need to be confused. Remember, we had discussed that there are two buckets available for investing, right? One is up to 365 days and the other more than 365 days. Well, the ratings too are divided according to this. So, for long-term securities, AAA denotes the highest level of safety. It goes down the order: AAA, AA plus or minus, A plus or minus, and BBB plus or minus. Till here, it is considered investment grade. BB plus or minus and below is considered junk grade, or very likely to default, with D being default. These ratings are provided by independent credit rating agencies. Now, for instruments with up to 365 days maturities, the credit ratings are as follows. A1 plus offers the highest level of safety. It is very common to find the same company having AAA rating as well as A1 plus rating, because they are issuing both kinds of papers with different maturities. So what fund managers do is they only select instruments whose credit rating satisfies the mandates of their funds. In this way, they can manage the risk levels of their schemes. I hope you found this interesting. In the next episode, we'll talk about how debt funds earn returns. In future episodes, we'll also cover the types of debt funds and the styles of managing them. Do remember to consult your financial advisor or mutual fund distributor before making any changes to your portfolio. Thank you very much for watching. I hope you found this useful. For more such videos, don't forget to subscribe to our YouTube channel. Stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.